Hi, today is Sunday, January 6th, 2019, and we're taking a look at the S&P 500 as we get ready to trade January week 2, 2019. First, nice full week of trading after two past weeks with holiday interruptions in the middle of the week for pesky Christmas and New Year's Day, interrupting our trading fun. I'm just kidding. Anyway, here we are looking at the 5-minute chart. This is like a completely cleared out version of my 5-minute chart. And you can see that over the course of the last, 3 weeks or so, we kind of formed this resistance at 21.21. I mean, sorry, 25.21. You can see that it broke down here all the way back on December 19th. That was probably the day of the Fed meeting. That we are about to get the minutes from, and that we just heard from Powell, and he corrected some of the errors in language that he spoke back here, and now here we are breaking out over that level. One of the reasons why this level probably also has been resistance is that there has been a powerful force in the market selling calls short, probably at the 25.25 level. And now that same force is probably going to come into the market and sell short 25.25 puts instead. So let's be mindful of the 25.20 to 25.25 level, and know that as long that we're probably going to see closes on Monday, Wednesdays, and Fridays above that, as people are now shorting puts there instead. And as the market goes up, they'll keep buying, they'll keep covering that short put, but adding money to their long put, which is down here probably at 2,500. I get into this a little more in the I get into the idea of buying some puts out into February, March, and beyond in the weekend pinned thread, and I talk about some areas that I think we're going to get to, and how for people that can't play, who can't just go in and buy the puts right now for $50, $70, $80 that they're running now, and then selling short against those over the course of the next couple of weeks as we get deeper into earnings season. That's how they absorb the cost that they put up for those. So if they bought a $2,500 a 2,500 put out into March for $100, they can be selling the 25.25 against it for $90, and or I'm sorry, for like if they bought this put out here for like $80, they're selling the 25.25 for $90. They're collecting a $10 credit, and they can either just sit on that, or they can cover it into moves up. And as we come back down, they'll be selling short the put again, and they'll just keep doing that until they're ready to pull the plug on the bathtub, and boom, down we go below this 25.20 to 25.25 level. Now, this might not all magically happen starting tomorrow. There might still be a move below this 25.20 level intraday, peaking below here and moving back up. But if not, this is the way I see it as happening. Our high on Friday came right up to the 20-day simple moving average. It's a falling level. I guesstimate that it's going to be at 25.32 tomorrow. That's a generous guess. It's probably going to be even lower than that, because it's been falling at a clip of about 12 to 14 points a day. I see it as flattening out a little, and maybe it's only going to be down half that amount tomorrow. You have to average all the days together to know exactly what it is. You could figure it out on your own if you're that nerdy and want to use your calculator for a while. You can do something like that. But I'm just guesstimating it, and then I'll know on the open, wherever that little orange line is on my daily chart. I will move this price level to that, and then I will know where the 20-day is. So I kind of guesstimate that it'll be, though, at about 25.32, right around where we closed on Friday. So if we come in flat, or even just a small gap up, we're gonna go ahead and run. And when you look at the daily chart, you can see it very clearly here. Here is your 10-day simple moving average. And on Friday, look what it did. It flattened and it ticked up. So on Friday's close, this is the first time we've had a rising 10-day simple moving average since all the way back here around Thanksgiving, when we came back from Thanksgiving. That was the last time, as we were heading into the G20 meeting. That was last time the 10-day ticked up. So it's ticking up, and you can see a little kink in the 20-day simple moving average. So that's probably slowing it down a little. because it's finally picking up the average of these days here, and not just solely these lower and lower and lower closes. We have some higher and higher and higher closes. So there are three things we're going to be looking for. We're going to be looking for a hold of that 25-20 level. We're going to be looking for a breakout over the 20-day, and we're going to be looking for higher closes. So we need to see a higher close tomorrow above 25.32. It was 25.31.94 was the close. Let's just use 25.32. If our 20-day simple moving average is there or a little lower, that will also be an easy killing two birds with one stone kind of thing, where we close above Friday's close and we close above the 20-day simple moving average. We're going to be targeting initially 25.25. Let's look to the left once again. That's this day right here, at the day of the Fed meeting. That was the high we made that day. That high coincides with the first break and new swing low that we had made about a week in the week before, when we finally broke down through 26.03 and flushed down to 25.83. So this is a true scene of the crime level, where it's an old swing low that obviously was bought, and you got a big move up over it, and then we broke down below it as we came into this Fed meeting, and then buyers took you up right to there, right up to 25.85, and then that statement came out. All it was a cut and paste of the November statement, and then at the press conference, Powell played, Mr. Hard Ass and talked about, oh, well, maybe we won't be doing 3, we'll probably be doing two more hikes, and the market was like, yeah, forget about that. Boom, down we went. For the rest of the year, culminating in our low here. So as we get to these the minutes from the Fed meeting, the market is going to be looking to see if in that meeting, if they were discussing, about, maybe we should draw it back a little further, maybe we should, maybe we should change the statements. No, for now, let's just leave it as is. But maybe if there's any evidence that there was some thought of dialing back the rate hikes discussed in that meeting by way of showing it in the minutes, then the market can rally up above 25.85. If we get up to 25.85 tomorrow, we still have a day and a half to trade before we get the minutes. Maybe we're going to bust on out of here, and we're going to go after the 50-day. So first you have the 25.85 to deal with, but then you have the 50-day to deal with. And you saw what happened here with the 10-day and the 20-day. You had an open on Friday, the gap up open above the 20-day. If we gap up open above the gap up open above the 10-day, if we gap up open above the 20-day on Monday, and we rally on up right to the 50-day, it could be just the same situation where they rally right up to the 50-day here and park it. This is also a falling line. If we don't get to it, it's probably going to be right about here, 26.32 on Tuesday, maybe down at the 26.20s or something like that on Wednesday. So just remember that this is a falling line, and the bar gets lower and lower each day. But at the same time, if we're going to come up to it and resist and roll over and never look above it, and never trade above it, that means we're never even going to get to our 26.67 measured move level. All right, I hope that all made sense to you, and that's it on the intraday stuff that we're looking at for tomorrow and so forth. Next, I'm going to talk more about the stuff that was discussed in that weekend thread. So if you don't want to listen to that, you can come back later. If you want to listen to it, here we go. All right, so to get to this measured move idea that I have here, you can see it on the roadmap. That's what these two blue boxes represent. If we just take the range from our low here to where we closed on New Year's Eve 2018, and we take that and we double that move up, that would get us to about 26.67. And right around 26.67, right, that level parks us right below the close. This is the 2017 close. This was the level that always marked us positive or negative for 2018. And then, of course, right above that was the 2018 open at 26.83. Okay, so if we get up to this level and that's it, and that's all we've got, it's a combination of a nice doubling up of this move and the market not ready to commit above this stuff here until we hear more out of companies regarding earnings. If we're going to roll over from here, this also gives you a perfect, mathematically, a perfect pullback from here of between 20 and 25% would get you back to those 2018 levels. Now, listen, we could move up even higher. We could move up here to this 2710. Remember this level? This was our very first low that we struck as we came into this sell-off. And then above that, we start talking about the 200-day and the 100-day simple moving averages. Oh, there's also something else here that was kind of interesting. Where is it? The 20, yeah, right here at the 50-day simple moving average as well is the halfway back point for 2018. So that's kind of an interesting level too that sort of intermingles in here. That has more to do with the 50-day. We'd have to get above that halfway back point for 2018. And a lot of people are going to start getting the idea that maybe we can move back to the all-time high once we make it back above the halfway back point. But if companies start coming out and warning about, and taking back their earnings estimates because of the fear that this tariff stuff is going to go on and that they're not going to come to any kind of a substantial agreement that would allow Trump to, pull back on raising those to 25% come March 1st, then people are going to be warning in their earnings that if that doesn't happen, that they're going to cut their estimates anyway, and then they will raise their estimates back up again if that doesn't come to pass on March 1st. So that would be the catalyst for why we might fail. This is the gap map chart. And when we back this out, you can see there's a clearly defined downtrend from the area where the all-time high is. And you can see all these sell signals that we witnessed with the bearish crossing of the simple moving averages. And as we get up to this downtrend off the all-time high, we have the downtrend, the 200-day, and the 100-day simple moving averages all in a row there. And the thing that could get us back down here, not just the tariffs, but also the developing investigation of the president. That's sort of like a two-hit punch of negativity and uncertainty for the market. Although I guess the idea, you never know. I mean, maybe the market might be like, great, no more, tweeter-in-chief. We'll have Pence, who doesn't even probably know how to use a smartphone, in office, and he'll be a nice yes man who will do everything that the puppies in Congress want him to do. The puppies in the Senate, I should say, not in the Congress, but in the Senate. He'll do what they want him to do. Maybe the market would actually rally if we took Trump out. I mean, it might sell off for a couple of days, but then it might turn around and rally because the market does the exact opposite of what you think it should do. But in any case, if we are going to have some sort of a completely nuts sell-off that just comes at us hard, 20 to 22% or so off from this 2667 level, this doubling up area or any area up in here, reasonably up in here, will get you back to 2125 or 2085. And as we came down into this sell-off, once we broke down below this 2461 level, we started filling gaps. And I've left them all on here, even though they've been some of them have been filled. I left them all on here so you can see we got all the way down here to fill this one from April 21st of 2017, but there's still all these other ones here. You can see in all these gray lines, these are all closes where we gapped open the next session and ran, with the final gap being below, off chart here, down below 2125. So let me roll to that area. That final gap and that area has to do with the election of 2016, the election of this president. Here is that section of the chart. And look what happened. We had the Comey letter, and we started selling off because it looked like, Hillary might not win, or even if she did win, she might be investigated. And wow, look what we have now. We have a president that was elected and is being investigated. But in any case, the market started selling off, finally moving all the way down to a Friday close just before the election at 2085.18. And what held that low? The 200-day simple moving average held it pretty much right on the money there. And then we gapped up open the next day on 2100. This is the Monday going into the election. And then we moved up from there. You can see here we moved through the 10-day simple moving average and pretty much doubled up on the day. We even moved through the 20-day and closed above it that day. We came back the next day, tested back down through the 20-day, and then finally on that was election day. Then we had election night, and we came in the next day. We came down. We held a higher low against the previous day, and that higher low was that 2125 level. And you can see here we opened above the 20-day, tested down through it, held a higher low, and then moved up from there. And that is where the 2125 level comes from that I talk about all the time. And the 2085 is this big gap down here. So this whole area from 2125 to 2085, in my opinion, is where we're going to go if this sell-off really does come to fruition. And we want to do, I'm going to get you dizzy again here, I'm sorry. And if we want to do a similar correction of what we got in 2018. And this correction from the high, from the all-time high at 29.41, 29.40.91, down to the low that we printed at Christmas was just over 20%. It was like 20.5%. So when you take out your little calculator and you judge what is 20% off of this bounce here, that would get you down to that 2085. Now, if we bounce a little higher, maybe the correction is going to not take us quite all the way down here, or maybe the correction is going to be a little more than 20%. Maybe it's going to be 23%, 25%, whatever. But in any case, that's where I kind of forms that thesis out of. That's what I keep talking about. That's what I think we're in for 2019. I don't know that it's all going to happen in Q1, but wouldn't it be great to get this all out of our way in Q1, get the tariffs solved during Q2 so that maybe we're kind of like trading down and we kind of like chop around sideways in this area here, and then maybe in June we have some progress on the tariffs. Whatever's going to happen with Trump happens with Trump, and we can recover and spend the summer and the fall of 2019 trying to get our way back to where we opened the year in the first place. That'll be what we'll be working towards. We'll be working towards 2,500 and then moving on from there. Okay, I hope this all made sense to you and was useful, and enjoy the rest of your Sunday. I'll be on later tonight looking at futures. Good luck in trading.